Okay, so a little bit about myself. My name's Alex Perny. I've been with Advanta since 2012. I started my career doing operational matters for clients, such as direct hands-on investing, getting actually to review a lot of these private placement memorandums and like. So I had over 1,200 individual investments that I worked with clients on over the span of about 5 years for doing these. So I've seen a lot of different types of structures. I've seen people, seen the potential issues that they've had with things, seen the successes. So again, if you have questions, please feel free to type this into the chat box. I'm happy to elaborate on anything that we're going to be covering here today. A little bit about Advanta. We're just about to enter our 20th full year of operations, so we're very proud of that. We have a great, robust operations and education team, and hopefully we can bring you some good information here. Currently, we have almost $2.4 billion worth of assets under management. I need to put a period in there. So sorry about the incorrect status of our AUM there, but about 2.4 billion of AUM here at Advanta. Also, all client cash held here is fully FDIC insured. And anyone that's looking to actually do this type of investing has a personal hands-on approach to it with our account management team. So everyone has a dedicated account representative that would be helping them with anything that they need regarding their account. And while we're going to be getting into this today, I just want to make sure that we separate what we do and don't do. Advanta IRA and our employees do not provide investment advice, nor do we endorse or promote any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. A few key takeaways I want everyone to have from this presentation today are the types of typical startup investment structures. So there's a lot of different ways to invest in private startup companies or private equities. Not all of them are created equal. All of them have inherent benefits and drawbacks. But I want to at least get people with a base level understanding of if you go out there and you hear a certain terminology or someone saying, hey, I'd like to raise money with X offer, you at least have kind of a baseline understanding of exactly, kind of what that is. Also, again, the key thing here is, baseline understandings of a lot of this stuff, because if you haven't ever ventured into the private equities world or the startup investing world, a lot of this stuff might be a little bit new to you. You might have heard, obviously everyone's heard of a stock. Everyone's heard of, probably understands what equity is, in a general sense. But if you haven't ever operated in this world, there's a lot of terminology and things that you just might not be familiar with, and hopefully we can get you some of that. So again, some of the rules related to IRA and startup and rules related to that are important as well, because not only are there IRA rules to be cognizant of, there's also some SEC rules that you have to be aware of, as well as some of the regulations that you might hear thrown around. And again, I always want people to understand that, trust but verify. I know it sounds great when someone that's trying to raise capital is, stating that they are regulated under some certain thing, or they qualify in some certain area for doing what they're doing. But a big thing with investing in the private sector, if you will, of equities investing is trust but verify. Because of the nature of these investments being unregistered securities, they don't have as much oversight or regulation from the SEC, and you don't get the inherent oversight that you do from things like shareholder meetings and additional regulatory filings that you might have to do if you are a publicly traded company. So understanding the rules and some of the risks associated with that are very important. And then also some of the great tax benefits that this might offer to you as the investor. And then also, the counter to that would be some of the issues that you might face. Because at the end of the day, investing in startup companies carries a lot of risk. Now, there is definitely a commensurate amount of reward that is carried if something does come to fruition or the strategy of the particular company pays out. But you have to understand that there are going to be, just as with any investment structure, there are risks, there are potential rewards. So understanding what they are on both ends of the spectrum is very important. So let's kind of start with the baseline. What is a self-directed retirement account? Now, you hear something like, hey, I'd like to buy stock. Well, I can buy stock in my Fidelity account. Why can't I do it with them? Well, with these types of securities and these types of offerings, you need a company that's willing to hold an alternative or a non-tradable security. That's where self-directed retirement accounts come in. It gives the owner complete control over their retirement funds and investment decisions. You actually get to go out, do the due diligence, find the companies that you'd like to invest in, and then bring it to us as the custodian, and then we can help to structure that and make sure everything is done correctly to maintain the tax sheltered nature of your IRA. And these accounts are invested outside of the stock market, and you do get to avoid some of the roller coaster effects of the stock market as well. Now, that does come with a few downsides that we'll get into later, because of market volatility in the stock market. That can be a bad thing, but that's also indicative of high levels of liquidity if you wanted to sell something immediately. We'll get into some of the issues with liquidity a little bit later on and how these investments are structured and why that might be a concern to you. Again, you don't want to see things fluctuate wildly, but also at the same time, the wild fluctuations in the publicly traded stock market do indicate something that is not offered in the private sector. When I say private sector, the sector of investing that we're talking about of non-publicly traded securities and equities. And, a big part about this is why this isn't as well known. You've been able to do this since 1975. You've been able to buy private shares in companies and do this since that time. Now, there have been some regulatory changes that have happened, especially in the past few decades, that have made it much more accessible for people to invest into private securities, namely back, let's call it the 70s, 80s, and 90s, and into the early aughts before the Obama administration. Really, the only kind of private stock that was really being acquired by people in IRAs was primarily bank stock. The raising of capital from IRAs really wasn't as available until a piece of legislation called the Jobs Act came into effect. And we'll kind of cover some of the regulations that are in that and what exactly that means for the investor of how, it kind of opened it up. But, at the end of the day, the reason that most people haven't heard about this is just the fact that, big banks have a vested interest in keeping you invested in products that they can make money on. So stocks, bonds, mutual funds, they make their money from the bid-ask price and the spread that they're making on with market makers for selling securities. It's a very lucrative business, and there's a reason why companies like Fidelity, TD Ameritrade, Charles Schwab, or TD Ameritrade is becoming Charles Schwab. But there's a reason these companies are so big, and the companies such as Advanta in the self-directed space are relatively small in comparison. The amount of assets that we have under administration is by no means small, but when you compare it to capitalizations in markets and AUMs in the hundreds of billions, if not approaching trillions of dollars, you can kind of see the disparity there. And the other reason is that there are regulations against banks and large wirehouses actually holding these types of assets because they are inherently hard to value. When you invest into some type of private placement or startup company, it's really hard to peg the value until something happens, whether that's good or bad. The initial purchase price kind of remains there. It's almost, a very educated hypothesis to affix a readily determined value. And these companies that are acting in a fiduciary capacity to their clients and are providing financial advice and publicly traded security and brokerage options are under the obligation to have more verifiable values for their assets. So that's another reason why those companies certainly could offer these types of investments, they elect not to. So, again, it's to the point that you need a specialized custodian, and this type of investing is not as popular or really a right fit for a lot of people as well. The nature of these types of investments can, again, be highly illiquid, which would lend itself to not being as big of a market segment as one might think. Now, let's kind of get into the types of accounts that you can utilize for investing in startups, because again, it's always good to know where you're exactly coming from, and the like. Just one moment, let me just got to change something. Okay, so understanding the types of plans that you can actually utilize is very important, because understanding where your capital is going to come from is kind of half the battle. So I've heard time and time again that, hey, I'd like to use my Roth IRA to invest in this startup, or this new offering's coming up, I need a Roth IRA. It's simply not the case. You do not have to do these kind of investments through a Roth IRA. Now, the benefit to doing them through a Roth IRA is pretty apparent. If you buy and are part of the initial funding group for a particular investment, and they have an exit and an IPO, and it pays out a 10, 20x return on your initial investment, paying absolutely zero taxes on any of that as opposed to some taxes is, probably ideal. The general thought prevalence of paying no tax versus some tax, I would assume is probably what most people would agree with. So you don't have to use a Roth IRA. Most people in the United States have money in traditional IRAs or tax-deferred retirement plans because they funnel money in from your defined benefit plans. They funnel money in from 401ks, 457s, thrift savings. So any type of tax-deferred plan that one might have had at a previous employer all funnel into a traditional IRA. And most people do not want to do a Roth conversion of moving their tranche of traditional assets to a Roth IRA and paying taxes in a large block. So again, you can do these types of investments through a traditional or Roth IRA. Now, the cool thing about it is the tax treatment of any of the types of plans up here are exactly the same when it comes to the realized gains while the investment is occurring. So let me explain it. So let's say you had invested in Sunshine Microprocessors when they were initially getting started. This is a fictitious name. When they're initially getting started. So you have this investment, you had held it for a few years, and then it sold for a 10x return. Well, normally you would have to pay long-term capital gains, around 20% on the gains that you would pay outside of an IRA. That's how it's funneled through. Now, granted, you can certainly help to reduce that with losses and other things, but that's generally the way it works. Now, with an IRA, whether it's traditional, whether it's Roth, a simple IRA, a 401k, a SEP IRA, none of those taxes are applicable. So if the investment pays back a 8x return, it goes directly back into that retirement plan. There's no tax return filed, and the money can be immediately redeployed into another investment. The only difference in taxation for these plans is whether or not you get a deduction going in and whether or not you pay taxes going out, meaning that if you get a deduction for putting money into the plan, it's a pre-tax plan. That means you pay money on the back end when you distribute money out of that plan. Now, you don't have to do any complicated basis calculations. It's just ordinary income at the amount that you distribute when you want to take money out of the plan. So if your account had grown by, let's say, $300,000 by investing into several startups, and you go to take a distribution of $10,000, you don't have to worry about calculating gains over the life of the account. You just pay tax on the $10,000 you took out of the account. Granted, that is applicable to traditional pre-tax retirement plans. So your traditional IRAs, your SEPs, your 401ks, your simple IRAs, just not the Roth. Now, there are Roth 401ks, and with current legislative changes in the Secure Act 2.0, there now are Roth SEP IRAs and Roth simple IRAs as well. I won't get too far into the weeds with that, but suffice it to say, no matter what type of plan you have, whether it's an old employer plan, a traditional IRA, a SEP IRA, all of these different types of plans can work to an effective strategy for investing in startup companies or investing in private equities in general. So let's cover a little bit about moving money into one of these plans, because normally when people talk to, let's say, a financial advisor in a large wirehouse, and they say, hey, I'd like to invest in, let's just use Sunshine Microprocessors as another example, they're going to say, well, no, you can't do that. You can't invest in that type of company. You'd have to take a taxable distribution, maybe pay penalties and all of that. That's certainly not the case. If you want to do this, you need to use a self-directed IRA. And essentially moving funds between one of those types of plans in an IRA is never going to be taxable. There's no penalty associated with doing so. In some cases, it is reportable, but there is no tax penalty associated with doing that. You just have to have a custodian that is willing to hold that type of asset. So again, I just want to put this up so people kind of have a general understanding of how to get started with it. There's not a whole lot of complication in it, even though people might have gotten roadblocks on the initial front end of being able to do this. If you've had a conversation with a financial advisor or someone else, you'll understand kind of the issues that might occur with the information that they're giving you, which is certainly not the case. If you'd like to do this type of investing, you are certainly able to do so long as you do meet some basic metrics and criteria. But again, that's going to depend on what type of offering it is, what stage you're coming into this in, how many investors they have, and a lot of other types of matters. So why are retirement funds a good source of capital for this? Well, as illustrated currently by the issues with Silicon Valley Bank, the tech sector with regard to finance, you also had Signature Bank failing. Granted, they were more in the crypto space, but a lot of financing and a lot of startup investing and capital management was being done by this bank. And it reasons to wager that this type of bank failure is going to cause a restriction in the velocity of money in this market segment. So for people that are looking to go the more traditional route of acquiring capital for a particular startup business, it is going to start to shine a light more on the individual investor for capital raising than it would on institutions. Granted, we're going to have to wait to see how exactly it flushes out, but again, just common thought processes that if one of the largest banks in the United States, the 16th largest and the second largest to ever fail, occurs, and they are primarily based solely in the tech startup and just call it startup private equities business, that is going to cause ripple effects. So the alternative to traditional financing is a big benefit of why IRA funds might be a good source of capital for this type of investing, and also on the capital raiser side of why targeting these types of people with this type of money might also be a good idea. Again, why are retirement funds a good source of capital for this? Most people are not expecting to use IRA funds very soon. And with the highly illiquid nature of private securities, IRA funds typically lend themselves pretty well to being a good source of capital for this. If you're already not expecting to use the funds for 5 or 10 years, and you're kind of planning on locking it up in an investment that might not have any type of liquidity event for at least that amount of time, then you really don't have to change your strategy or your budgeting personally to kind of make that feasible option for you. Now, granted, you always need to look at this on a personal basis to make sure that, hey, if I'm going to be investing in something that does not have a ready market in order to sell it, even if it's something for at least 3, 5, maybe I've seen private stock outstanding for 10 years, and typically there are restrictions on being able to sell this stuff. And even if you are able to sell it, going back to the issue of valuation, how do you peg a value on it? You might have to sell for pennies on the dollar if there isn't any type of liquidity event or change with the company in order to recoup any of your money. So utilizing funds, again, that you already aren't planning on using is something that is to be considered when looking at using your IRA for this. Looking for alternatives. With market uncertainty and trying to look to the future, we're seeing such a shift in the types of companies that are out there to invest in outside of what are considered the traditional stalwarts of investing. So think about your industrialist type of investments, your GEs, your General Motors, all these different types of industries that we're seeing a shift away from in new and emerging markets. I mean, think just for a second about the emergence of things like artificial intelligence and machine learning, cryptocurrency, medical tech, and all sorts of different things that have the potential to pay extremely high returns if you do make a sound investment that aren't kind of in the same vein as what people are most often used to. So looking for those alternatives, again, being a good source of capital and a great tax benefit, especially if something does go well, is another great benefit. And then lastly, kind of again, the prevailing theme of why IRAs are looked at by most people, whether or not you're investing in private equities or not, would be the preferred tax treatment of IRA funds, meaning that you have tax deferral, tax exemption, you have a tax shelter that you can utilize for these types of investments. Not only does that help you to reduce any potential large gains in taxes that you might see, it also helps to simplify your tax reporting as well. And I'll get to why that is in a moment, but most people don't realize how this can inherently simplify your personal taxes by utilizing an IRA for this, because there aren't any complicated returns to file. Any type of capital that is received back from a investment into some type of startup or private equity is paid directly back to the IRA. It doesn't hit your personal tax return, but that does have a counter argument when it comes to losses. So let's spend a little bit of time on looking at what some of the options are out there, what you might kind of typically run into when it comes to investing in startups. And I'll kind of go into a brief description of what each of these is and why that might be something that you want to look at, or you might be something that you want to stay away from. Now, keep in mind, because you are not investing in a traditional sense, and if you are just used to investing in stocks, bonds, mutual funds, things that are traded on an open securities market like the New York Stock Exchange or another publicly traded stock exchange, you just might not be familiar with some of these terms and what they inherently mean. So I want to make sure that people have a base understanding of what these are, so that way you can make an informed decision, or at least know where you need to do some additional research. So I put straight equity up there first. Now, this is what most people, are kind of thinking of when it comes to private stock. Just as with a publicly traded company, if you buy 5 shares of Coca-Cola, you own a part of that company. It's one of the cool things about the stock market is that you are a part owner of Coca-Cola or McDonald's. Granted, if you only own 5 shares, you're not a very large owner, but you are still an owner of that company and get to enjoy the benefits of the rise in the value of the company, but you also participate in the risk of losses with the company with your share price going down. Now, how that plays into equity is that most of the time, when it comes to investing in startup companies, they're going to be offering equity because it is definitely a preferable position to be in if the company were to sell. So most companies, when they are startups, they're looking for kind of two different exit strategies in general. They're either looking to get acquired by another company, so that way when the company comes in and pays X amount of dollars, let's say $100 million for the company, then all of the initial equitable owners of the company get paid out basically at the same rate. You take the number of owners of the company and you divide by the amount of money, and that's how much everyone gets. That's a relatively easy concept to understand. But when it comes to investing in startup companies, you might have different classes of shares, just like you might have different classes of shares on, let's say, the New York Stock Exchange. But those are typically looked at when it comes to things such as dividends. Maybe they have a dividend-paying share class. Maybe they have just an equitable share class. There's different reasons for different classes of shares, and we could go on for days about that. But when it comes to equity investing, you need to be aware of where you land in that capital stack of investors, because the investors that are raised on, let's say, a Class C share or a B share or not a preferred equity share, there's all sorts of different types of minutia that goes into what type of share you own in that company, which is going to determine what your payout rate is if the company is acquired. Obviously, the people that are the preferred shareholders are going to get a larger chunk of that, a larger piece of that pie. If you are down that stack of investors, you're going to get a fractionally smaller payout. So just don't understand that if you come in and you are buying private stock in a company, not all shares are created equal. So make sure that you read any and all disclosures. And if you have questions about this stuff, talk to a financial advisor or someone that is a professional or understands these types of markets and securities. So that way you're not investing in something that, you think, hey, if they get bought out, I get an equal share of that pie. Well, that definitely may not be the case. There's a lot of different ways that people structure these equity offerings to be able to raise capital from investors. Then from there, not as common in startups, but it is certainly something that kind of falls into the umbrella of private securities, are limited partnerships. This is more indicative of people that are doing security offerings for the acquisition of a certain type of product, namely things like commercial real estate. But they can use these things for anything else. There's limited partnerships that come in and actually buy, kind of operate like a quasi hedge fund, where they come in, everyone is a limited partner in a type of fund, and then they go out and that fund goes and invests in certain startup companies. Then the returns of that company are paid out on a prorated basis to all of the investors, and that could be a way to kind of spread out, if you will, your invested funds over a larger area. And again, limited partnerships, I probably should kind of put under private hedge funds as a subset, because that's more often than not how a lot of those types of structures are done. There's a general partner, there's limited partners. More easily drawn correlation would be something like a managing member and then subsequent members of an LLC in general is how that kind of plays out. But again, if you see something like a limited partnership, just because it doesn't say private stock, doesn't necessarily mean you don't have an equitable interest. You certainly do in that particular company, but you always need to look to the investment strategy of a company or a limited partnership if you're investing in this strategy. Not to say you shouldn't look at the company in another regard of what you're ultimately investing in, but limited partnerships are something that's out there and not necessarily something to shy away from. LLC membership, again, with corporate structures comes different ways that they offer investment opportunities to investors. LLC membership in general isn't the most common type for private equity investing in startups. While the LLC may certainly be, they may operate as an LLC or they may operate as a C corp. The offering can vary widely, but LLC membership is out there. Now, I would encourage people to just make sure you do your homework on what it means to be an LLC member, especially with an IRA. There might be additional, liabilities that are passed through. You're owning an actual chunk of the operations of that company. Now, that may pay out better potentially in an acquisition scenario rather than some type of classified share of a company rather than being an LLC member, but it might offer, some additional risk and exposure to you if you're investing as an LLC member, as opposed to a limited partner or just owning direct stock in a particular company that's offering stock. So that is certainly an option that's out there. We see this a lot more, not on the larger scale or the more formalized startups, but maybe a smaller business that's looking to raise capital. So maybe a group of friends that are looking to acquire, maybe 3 or 4 local laundromats and start like a laundry business or something, on a much smaller scale. You'll see the offering of LLC membership be used in that category a little bit more often than you'll see that kind of in the larger end of that spectrum. So not to say it's any better or worse, but just kind of understand where these things fall in. That'll kind of help better guide you on saying, okay, this is maybe a little bit more normal, or maybe understanding when something's a little bit less normal and you maybe want to do a little bit more research on why they're doing something like they're doing. Convertible notes are kind of an interesting one as well. Now, these are used in a few different scenarios. So let's say a company, for whatever reason, they're trying not to dilute the equity of their company. They're not trying to sell additional shares of their company, whether that's to retain current shareholder value or has something to do with the valuation of their company, or maybe they'd like to adjust, how their company is valued. They'd rather take on debt, but they would also like to give the individuals that are investing the opportunity to maybe have that turn over into equity. So it kind of offers a nice little hybrid model. Essentially, what happens in this scenario is that the company will issue a promissory note to an investor that pays a certain rate of return. So you, as the investor or the IRA in this scenario, would actually lend money to the actual entity and then receive a certain rate of return. Now, in this scenario, there might be certain triggering events that would allow you to convert that promissory note into equity in the business. Now, this would allow the company to no longer pay on that note and then convert it to equity. So the consideration on the note being converted to equity is the benefit that you receive in that scenario. So as opposed to getting your money out faster, you might be able to convert it into something that might pay out at a significantly higher rate. Now, again, this is something you need to make sure that you are, willing to accept some of those risks, and that if your strategy was initially just to get steady cash flow, that you might then in turn be, forced into a conversion that you would then be holding something that's highly illiquid. So convertible notes, can certainly be a good option for people, and there's reasons that companies do this as opposed to, maybe just selling additional shares. But they certainly do fill an interesting hybrid when it comes to investing in startups. Debentures are kind of a fancy word for unsecured debt. It's if the creditor fails to pay, then you're kind of out of that. So it's, again, something that is not backed by any type of corporate stock or security. It's more or less kind of an unsecured note that's being issued to the company from your IRA. Now, with risk comes reward. Debentures might pay out at a significantly higher rate than other types of investments, maybe more for a cash flow type of play. But again, risk versus reward. Does that make sense to you? Syndications and private hedge funds are two things up here that kind of also fall into the vein of limited partnership. Syndications are kind of a catch-all term that might include hedge funds, that might include limited partnerships. But if you see the word out there, it's not anything, inherently exotic. It's maybe just a different way of referring to something. Syndications being a little bit more directed towards the commercial real estate space, where you have limited partnerships being formed for the acquisition of a certain asset. Again, not so much in the startup company type of atmosphere, but it does fall under the umbrella of private securities, and I wanted to include it there. And then lastly, private hedge funds. Hedge funds, again, do offer the investor the ability to maybe have a slightly higher amount of liquidity without the restrictions on selling securities that you might have with just a direct equity position. But they do offer basically the same thing that a publicly traded hedge fund would offer. You put money into a particular fund, and then that fund downstream, if you will, goes and plugs the investor capital into many different pots to help mitigate risk and get more market exposure to potential upside for their investors. Now, these types of investments, again, are going to be private. They may not necessarily offer as much liquidity as people might want, meaning that if you would like to sell it, you might be restricted from doing so, especially with private. I don't know if I mentioned this earlier, but especially with things like anything up here, there are typically going to be restrictions on your ability to sell any of these things within an IRA, or if you bought it personally for that matter. So if you'd like to acquire something, you say, you know what, this isn't for me, you might inherently be locked into actually having to hold that for the duration of the life of the investment. You can't just go out and sell it. One, there might be restrictions directly related to the investment offering documents, which would be detailed in something such as a private placement memorandum or in a copy of subscription documents, prospectuses. These are all things that are required to be disclosed within the context of, like, let's say a Reg B filing, and we'll get into that in a moment. So again, these are kind of the general structures that you're going to see if you're investing in startup companies, whether that's equity, limited partnerships, LLC membership, convertible notes, debentures, syndications, private hedge funds, are kind of the general ones that you're going to see. So what are some of the benefits and the drawbacks to investing in startups? So some of the IRA benefits, it definitely offers you a greater variety of investments. If you can get out there and invest in things before they hit the open market that are new and cutting edge, just look at, it's easy to draw the correlation, for something like if you were able to invest in Facebook when Mark Zuckerberg was just dropped out of Harvard, how much would that have paid off for you? The ability to have access to additional markets is a huge benefit. Now, granted, not everything's going to be a Facebook, and not everything's going to be a Google or a Tesla. You're going to have to obviously, be realistic with, what your returns might be expected to be. But the ability to get in on the ground floor, if you will, is there. So offering the greater variety of investments at earlier stages for market entry and more capital utilization are huge benefits to utilizing IRA funds for investing in startups. And then for the companies can find money outside of traditional routes, as illustrated by what is inevitably going to happen with the market for startup financing after Silicon Valley Bank's failure last week. We're definitely going to see a lot of need for additional capital, and there's roughly $37 trillion worth of retirement plan assets out in the world right now. So, understand there's a lot of money out there. If you're on the side of needing additional capital, there's a lot to be had in this market segment. Some additional benefits, potential for large returns. You can get this and not have to pay any taxes on it at the immediate receipt of that. Now, if you have that in a Roth IRA, you don't have to pay any taxes on it ever. So if you 10x your money, if you invest $100,000 and then you get paid back $1 million, you never have to pay a cent of tax on any of that, and you don't even have to do any funky tax filings as well. It just all goes back to the IRA. Nothing flows through to your personal tax filing statement, and it's just that easy. And you also don't have any active work on behalf of the IRA owner. Investing into a private startup company is basically as hands-off, after you've done your due diligence, as investing into anything on the New York Stock Exchange. It is very hands-off. It gives you the ability to simplify your investing life, especially if you're coming from a more active standpoint. These things are locked up for a while. They are not very liquid, and you essentially get to set it and forget it. Granted, there is higher degrees of risk in this, and we'll get into what that means for you as the investor of being able to qualify for some of these investments. But not having to work for your money is definitely a good benefit. Now, what are some of the drawbacks to this? These investments, again, and I've said this time and time again, and I think it bears repeating, are highly illiquid, meaning that if you buy stock in a private company, there's not a readily open market that you can turn around and sell it on. You might have buyback clauses from the company that states that they get to buy it back at a certain fractional price per share than what you bought it at. Or there might be a restriction on it being sold at all. So you might just be locked into it until something happens. If you do have any inherent need for this type of capital, personally, so if you need to live off a retirement fund, or you have, the potential for something to happen in your life that would affect you needing to draw into a retirement plan, investing in these kind of things with an IRA should give you pause, because you can't just turn around and sell it. There's no way to extract cash out of that until there's some type of an event that would generate cash for the company, whether that be some type of buyout by a larger company or a competitor, whether that is an initial public offering, where then there would be a readily tradable market. But these things don't happen every day, and understanding what the runoff is and the risk of being very illiquid in a retirement plan especially is very important. Again, no definitive payout date. You also have the possible dilution of value with subsequent offerings. You can't necessarily control what these companies do, and if they need to raise additional capital and they issue another large tranche of shares, well, you may not have a direct course of or direct action recourse to stop that from happening. So if you thought you were going to be sitting very well and they were positioning to have an IPO, initial public offering, or some type of buyout, and they issue 100,000 more shares, well, that's going to inherently dilute your position in that company. You would be getting paid out significantly less per share than you otherwise would have. So with private companies and with the less regulation involved in that and the less marketable nature of these, as with something traded on an open stock market, if they issue new shares, yes, the share price might drop, but it's the prevailing sentiments of the market will typically cause that to go back up to where it was eventually. So keep in mind that can happen. And less regulation can afford more risks to investors because there are less regulatory matters that come down from the SEC and other governing bodies. There is an inherent higher degree of risk with this. Now, there are people out there acting in bad faith. It's because there's less regulation and oversight. There are the potential for people to do criminal things with private startup companies and private hedge funds. So you definitely need to do your due diligence and understand very well what's happening. And the old adage holds true. If it's too good to be true, it probably is. If someone is out there, offering a guaranteed rate of return of 20% on their investment, be wary. Not to say that can't happen or that doesn't happen, but be realistic when it comes to investing in these things and take a very pragmatic approach to it. Will be a very good course of action for any investor in anything, but especially when it comes to things that are inherently as risky as investing in startup companies. So many companies fail in their first few years of business. This is not new to the startup world either. And one big thing that people need to understand, with the inherent big reward comes very large risk. And also additional to that risk is that investment losses in an IRA do not carry over to you personally. So if your IRA generates a significant loss, let's say you invest in a company and their technology doesn't pan out or the market shifts and the company goes out of business, which does happen every day, and you lose your initial invested amount. Let's say you invested $100,000 in your IRA. Well, you have no way to kind of recoup that as a loss personally to write off other capital gains or anything like that. It is just money that is lost in your IRA. So if that is a concern to you, just keep that in mind, that you cannot, use some of the more traditional finance strategies of investment losses as maybe a tool to offset future gains. So what are some rules regarding to this? There's IRA rules and there's also regulations with regards to who can invest in what and at what time. So in most cases, when it comes to investing in private equities in general, whether that's a private hedge fund, whether that is a private stock offering, convertible notes, or anything that isn't generally considered private equities, you have to be an accredited investor. Well, what does that mean? It's an individual or household net worth over $1 million, excluding your primary residence, income over $200,000 individually or $300,000 joint in each of the 2 prior years, and a reasonable assumption that you would have the same in the current year. And depending on the investment, this may or may not be required. And that's mainly going to be due down to how they actually solicit their investors and what the nature of the investment is. So back under the Obama administration, the Jobs Act, JOBS, I can't remember what the acronym stands for, created several different regulations and rules which allowed for additional solicitation for private companies to raise capital, namely rules 504 and 506 under Regulation D of the Jobs Act were what created the ability for companies to go out there and more openly solicit and try to raise capital from accredited investors. They didn't have to be as closed off or walled, kind of sit behind the walled garden, if you will, when it came to getting financing from only traditional sources or maybe just a personally known angel investor. They can go out there and actually kind of market their investment to investors, but typically they would have to be accredited. Now, this is definitely on the more medium to large scale of raising capital. And again, this is a very big part where I might want to additionally disclaim, if you're on the side of wanting to raise capital for maybe a small project you have going on, going back to the illustration of a few people wanting to go out and invest in excuse me a few laundromats, and they say, hey, we need some money you use your IRA to invest in part of their LLC. Well, there really isn't, people like to throw around the term friends and family. That's not actually legislated. It's kind of a colloquial term used for basically the general early onset capital raising for private companies. So just keep that in mind, is that, there are some misnomers out there, and you need to do your research to make sure that the company, one, if they're, doing things by the book, they're going to understand what they're doing. They're going to have an SEC attorney involved. But again, if they're maybe using terms a little bit outside that, or they say, hey, you don't need to be an accredited investor to do this, I would always check and make sure you understand why. And the reason you have to be an accredited investor to do a lot of this stuff is that it is very, very risky. The rewards are high, but so are the risks. Now, if you are an accredited investor, your accredited investor status personally extends to your retirement plan. So let's say you don't have $200,000 in your retirement plan, or you don't have $1 million in your retirement plan. That's fine. If you qualify as an accredited investor personally, you can use your IRA. That accreditation status extends to your retirement plans. Also, you have to be cognizant of prohibited transactions. A lot of times people will, will hear about opportunities to invest in startups by virtue of being related to someone. Let's say your child is investing in, or your child is starting a private placement, or you are creating a startup company, or something to that nature, where you have some type of relationship with that individual, or it's your own startup that you're looking at as well. Well, typically you cannot utilize IRA funds for investing in a entity you own or control, or a disqualified individual owns or controls as well. Now, one of the nice things about the regulations from the Security Exchange Commission under Reg D of Rules 504 and 506 of the Jobs Act is that it might allow for that to happen, because there's no preferential treatment being given. It's newly issued shares, so long as there's no additional preferential share pricing being given or payout schedule being given to that individual's IRA investing. There might, again, I like to be very clear with my words here, might be an opportunity forward. I would always make sure that you check with the SEC attorney that's setting up the PPM, the private placement memorandum, and other subscription documents to see if they have any issue with your particular IRA investing in something with someone that you are directly related to. Again, so I always like to disclaim that there might be certain exceptions, especially in this arena of investing, but you would need to check with legal counsel to make sure that that would be a viable path forward, because committing a prohibited transaction with an IRA is definitely something that you would like to avoid at all costs. So again, just to illustrate who are disqualified individuals for IRA owners and with regard to these companies. So an entity owner controlled by any one of these people would be disqualified from you just going in and buying their shares, maybe with your IRA. But if they do have an open solicitation or an open offering, the opportunity to use your IRA would potentially be there. But typically, I like to guide people away from investing with their nuclear family, just because it can be fraught with issues. Not to say that it can't be done, but I would always, paying for maybe $500, $400 to $600 of a attorney's time to go over something and really kind of give you proper legal guidance if you are going to be investing with a family member's project is cheap insurance, in my opinion. It's, if you're talking about investing $50, $100, $500 million of your retirement plan with someone, I think paying for that front-end consultation is probably about the cheapest insurance you're ever going to find in your life. So just be aware if there is a project that you would like to be involved in, and especially with your IRA, and it is involving one of these disqualified individuals, or it is with a company that you personally own, you definitely need to make sure you check with legal counsel, because there could be issues. So let's look at a case study. Before I get started in this, I just want to ask you if anyone has any questions. Been all kind of quiet on the question front. If anyone has any questions, feel free to chime in. The case study will kind of round us out for the hour on what we're talking about. If anyone does want a copy of the slides, feel free to fire that into the chat. I will be happy to address that. But just let me know if we have any questions real quick before we get into the case studies, because we are running up a little bit on time. Once I do the case studies, I think it'll bring us right to about 1 o'clock. All right, well, let's get into it. So in this case, private stock, it isn't not that complicated from a transactional basis. most of the research, most of the difficulty in doing this is one, finding the companies to invest in. Two, making sure that it is a investment that meets your investment criteria of what you're looking to accomplish. And three, making sure that you're doing your due diligence on the viability of this being something that's going to, have a tolerable risk profile and also pay out potentially what you think it's going to do. The actual investment side of things, once you find something like this, is very straightforward. And that's one of the other things that I like to illustrate is that one, tax filing with this stuff is extremely easy because none of it flows through to you personally. And two, that the investment process is very easy as well. There's not, a steep learning curve on any of that. So if you're familiar with doing due diligence and the like, the investment part's easy. So let's take a look. How does this work? So in this case, Larry has a rollover IRA from a previous job and is looking to invest part of the $250,000 balance. His business acquaintance with Mike, who is part of a team forming a new private insurance company. The insurance company is looking to issue stock to raise capital to get the company off the ground. So, startup company in the insurance business, what are they looking to do? Well, they need to raise capital. So what happens and by whom? So Larry would open his IRA account. He requests the transfer of $100K from the other custodian, reviews the investment prospectus for the new company, decides to purchase 100,000 shares at $1 per share. He reviews and approves all the offering documents and the stock subscription agreement. And these are all type documents. So the offering documents and the subscription agreement, typically called the PPM and the subdocs, are all provided by the company. This is not something you need to have an attorney draft up. This would be provided by the offering company. And again, this is going to change depending on what type of investment it is, whether it's direct equity, whether it is something like a convertible note, whether it is a debenture, limited partnership. Names will change slightly, but the investment package, if you will, the investor packet is going to be relatively similar no matter what you're doing. So what does Advanta do in this scenario? Well, we get the account open for Larry, and then we request the funds be transferred over. We make sure everything is properly titled in the name of the IRA as the investor on the stock subscription agreement, on any type of other documentation that would need to be done for the IRA to be the investor. We have to sign that subscription agreement for the IRA, wire funds for the purchase, and then hold the original stock certificate for the investment for the IRA. Now, paper certificates have kind of fallen out of vogue. They still do issue paper certificates sometimes, but more often than not, this will be done in some type of book entry with some type of stock transfer agent that will do the bookkeeping and the record keeping for the outstanding shares of the private company. So what exactly is the investment strategy here? Well, the company is planning on having an IPO, meaning that they are trying to get listed on a stock exchange, so that way they're to grow their company to the point where it can be listed on a stock exchange. So Larry essentially at this point is holding the private stock within his IRA indefinitely. Their strategy is to get an IPO, then he's basically holding it until that actually happens. So again, he is investing with his buddy Mike. Mike positions the company over a few years to have the company go public. The company goes public, and 3 years later, the shares begin trading at $2 a share. So we work with Larry would work with us at that point to have the shares transferred over to a brokerage account. And after the IPO, Larry sells his shares for $2.25 each. So he bought it for $1 a share, sells it for $2.25 a share, returning $225,000 back to his IRA tax-free. So the investment strategy is very easy to understand. It's a classic buy low, sell high strategy for almost all of this stuff, or acquisition buyout type strategy. But the processes for doing the investment really aren't inherently complicated. It is actually just that simple. So, with that said, I really don't have too much else. I also like to illustrate, if you are someone that is in the position to raise capital and you are looking to invest in the startups, or you're looking for you're someone that's looking to get your capital deployed into startups, we do actually have a platform for people to come in and pitch different deals or capital that they need or they're looking to deploy. It's every other Friday. It's called our Pitch, Promote, and Prosper web call. The next one is going to be next Friday from 12 to 1:30 p.m. Eastern. Everyone is given an opportunity to pitch. If you would like to come, we'd love to have you. It is not recorded. It is not distributed by Advanta. So keep that in mind. It's just an open forum for people to come to try to either raise capital or get capital deployed. With that said, that is basically it. I appreciate everyone tuning in today. We're just getting right up on the top of the hour. If there are any questions, I'll stick around for a few more minutes, but thank you very much for joining with us today, and I hope everyone else has a great rest of their day. Can you invest in crypto? Yeah, there's several different ways to invest in cryptocurrency. If you would like, it's not exactly the easiest question for me to answer directly in this forum, but feel free to shoot me an email and we can set up a time to talk about cryptocurrency investment options for IRAs as well. I'm happy to review that with you.